Two experts, one hot topic, all sides explored. This is The Flip Side. The Flip Side is a podcast series featuring lively debate and opposing viewpoints on timely topics of importance to markets and businesses around the globe.
Welcome to The Flip Side. I'm Brad Rogoff, head of research at Barclays, and I am joined today by Themos Fiotakis, our head of FX research.
Thanks for having me on, Brad.
Well, you don't have to thank me, actually. You can just thank the volatility in FX markets for having you here. Speaking of which, it wasn't long ago when not just FX people, but any armchair economist was predicting a dollar rally if President Trump moved forward with his proposed agenda, including, most prominently, tariffs. Well, he has certainly moved forward with those tariffs, yet the narrative has now turned into widespread concern that the age of the mighty dollar has come to an abrupt end. The world is seemingly losing its faith in the greenback, and the market is very long U.S. assets to unwind.
It's true. This was meant to be a very bullish set of policies, at least in dollar terms. And it was executed in such a way that in reality, it has created a large potential for cyclical and reputational damage to the US and the dollar by extension.
But is this sentiment, can it just be down to the Liberation Day announcements themselves?
Of course, this is not just Liberation Day announcements, for sure. But let me just start by saying that the notion that free trade is optimal is actually a misnomer. When you think about it in macro terms, what is optimal is free trade when there's no distortions from either side. If either side already applies protectionist policies, then the optimal response is not free trade. It's some measure of self-protection, again, in macro terms. And in that sense, targeted policies like tariffs in some sectors, subsidies in others, restrictions to imports or exports in certain areas could have actually led to a stronger economic outcome on net and a stronger outcome for the dollar by extension, given nations such as China have applied their own industrial policies, for years.
But a blanket trade war versus the world is obviously not targeted, and I think it would be hard to argue that it's optimized. And really, you're picking a confrontation with a huge trade bloc, even bigger than the U.S., and the U.S. could ultimately stand to lose from that if tariffs get retaliated against it.
Yes, and what is more, the damage to foreign relationships, the unexpected reactions of other nations like, the German fiscal stimulus, they've all contributed to a shift in consensus from dollar bullish to outright bearish. Our own sentiment indicator concurs that the market has actually shifted positions from max long dollars in February to max short dollars and now. And we have also acknowledged the overall cyclical and otherwise damage, with our forecast now hovering at 115 for the euro dollar. Now, that said, I would push back on the more structural dollar angle, at least in the here and now.
All right, you gave us a nice little history lesson there, but I want to press on one of your last points. So on the euro dollar, why not more than 115? If we look at the history of the euro, these levels really, they're pretty far from being remarkable. And then if we take a step back and we look at a measure of net assets held by foreigners with respect to the US, it's grown by more than 21 trillion since 2014, last decade or so. And about half of that is the inflow of capital to the US. The rest is valuation gains, obviously. So even some moderation in the inflow of capital could lead to quite substantial dollar downside against a backdrop of large government deficits and US financing needs, I would think.
Well, this is almost eventually true to happen. It's very likely to happen. And we have been monitoring the rising deficit in the US international investment position for a while. But, whether a strong and stable trend reverses today is a much bigger call than the market realizes, Brad. In the last 25 years, we have only seen two such mega pivots in global capital flows. The first one was the end of the tech bubble in the early 2000s and the rise of the BRICS as an investment theme there. For more than a decade, the market saw more opportunities outside of the US than in the US. And then, around 2014 onwards, the drop to growth in China and the rise of US big tech shifted the opportunity landscape, with capital being directed back to the US without any alternatives in the minds of investors. Infamous no alternative kind of thesis. Can the US stop presenting a good opportunity in corporate profitability, and could a rival investment destination rise? It can, but it is hard to see this happening on the back of tariffs alone or as a result of some kind of independent capital flow decision. It is to us a much deeper and much more fundamental investment question.
All right, but I guess another way of asking this is, do you need to call the end of the Magnificent Seven effectively to call the end of the mighty dollar? I mean, surely we're talking about the most liquid market in the world here when it comes to USD in the FX world. I mean, can't you just hedge part of those very large, outstanding positions?
Well, almost surely some of this is probably happening on the margin, but bear in mind that it could be a lot smaller than the market is thinking about. For instance, fixed income investors are to a very large degree FX hedged. Equities are not. But a big part of the increase in foreign ownership of US equities has happened because of valuation gains, passive flows like ETFs, as well as retail participation. All that is very unlikely to be hedged. And, what is more for the more sophisticated investors, hedging costs have increased due to rising interest rate differentials, and the dollar has moved to weaker levels. All of that means that it's less profitable ex ante to hedge. And one last thing, equity investors are dealing with such huge swings in their portfolios against which, FX moves really, truly don't matter. So to me, ultimately, the question is, do you buy or do you unload your US equity position? It's much less so whether you hedge the FX portion in particular.
I want to dig in a little bit deeper on some numbers here. So you've said the dollar is sitting at weaker levels, but if we zoom out, and I alluded to this before, that sounds like a little bit of a stretch to me. And when I was talking earlier about Euro USD, I said it didn't look stretched over a longer time frame. In fact, in real terms, against advanced economies, the dollar is sitting about 25% above its 30-year average levels. So surely that has to raise some real downside risks.
Yeah, that's fair. And let's go to prices and levels. Some of that huge increase in the value of the dollar that you described has happened for some good fundamental reasons. And, when you account for those reasons like productivity growth, terms of trade improvement as the US became an energy exporter, what you get is that, the fair value is closer to 115, where our forecast is. And, the dollar can trade weak to fair value or strong to fair value, depending on the cycle. But even at a time where the US monetary policy was super easy in 2020, the euro dollar didn't extend much above 120. Not to get too technical here, but do we know that valuation models can capture structural breaks? Well, sometimes or most times they can't. So one has to be open-minded to these models. But in light of all the uncertainty, I think the discussion of a structural break in valuations is very difficult, very elusive. So I prefer to think of the dollar here and now in cyclical terms.
So before we get to the cycle, let's just close the loop here with the key structural conversations. As we all know, the U.S. runs a sizable trade deficit that is financed via capital inflows. The imposition of tariffs implies a smaller trade deficit, especially the way it's been calculated, and potentially less trade overall with the rest of the world. So doesn't this in turn imply less sponsoring for U.S. capital markets by foreign surplus nations? I would argue this would carry negative implications for U.S. assets and the dollar by extension.
I think this is a very important point and one that investors bring up a lot. It's true, a rapid decoupling of the US from global trade would indeed shrink capital inflow. That is an accounting equation. It would also imply larger domestic savings, which can be used to buy assets. So it's not clear ex ante which side wins. The lack of inflow from the rest of the world or the increase in domestic supply of savings. Usually, closures of the trade deficit come with large recessions, at least in the US context. And the one recent, or at least we're dating ourselves here, but recent within our career spans is 2008. This is one of the recent occurrences where the US current account deficit closure was met with actually disruptive dollar appreciation as opposed to depreciation. This is because together with flows disruption, leverage was unwound, and usually that ended up leading to funding shortages and the usual flight to quality type dollar strength.
So we've so far speculated on what the private sector may do. But at a time of a lot of geopolitical noise, the issue of the dollar as a reserve currency deserves some special discussion here, I think. So I know you've done some work in the past on using FX reserves to spot the early signs of potential de-dollarization. I would think that with U.S. foreign relations deteriorating, this trend could accelerate.
It has been happening, as you say. Sometimes this was linked to geopolitical consideration. For instance, Russia de-dollarized well before the war in Ukraine. I would, however, note that half of global trade, which is a much larger share of trade than what the US trades with the world alone, half of global trade is invoiced in dollars. The fact that half of the world's reserves at the moment are held in dollars sounds optimal, and actually, if you think about it in precautionary terms, even a bit low. The big issue as well is that there's no real alternative. The euro is one potential alternative, but it doesn't have a deep enough safe asset to accommodate the scale of reserve holdings. And, China's restrictions to capital flows reduce the potential for the CNY to be owned for anything else beyond transactional purposes.
That argument can hold for the current state of the world, but I still think secular changes could mean it's different over time. But for now, let's move to the cyclical forces you alluded to earlier, where I think there's another fairly bearish argument for the dollar. First, we've revised our U.S. growth forecast quite aggressively this year on the back of labor supply, fiscal, and tariff-related reasons to incorporate a modest recession. Second, our economists have shown that a trade war with the entire world would lead to a larger damage in the U.S. than the rest of the world. And third, the dollar gains that you, and to be fair, most of the FX community estimated would result from tariffs, they applied to a much more thoughtful and nuanced schedule of trade policies, which doesn't seem to be what it's actually applying here.
That's right. And the growth shortfall is the main reason why our dollar forecasts were ultimately downgraded very recently, brought closer to market. However, let's be clear. If the economy was to react exactly in line with what we're forecasting, meaning you get a one-off hit to prices and output, and then you get a partial recovery, then I would argue the market is fairly priced for that at the current levels. Maybe the market would need to negotiate the degree of the recovery in 2026, but that cuts both ways. You can have a better or worse recovery. So the balance of risks around that could be equal. What is a lot more onerous as a downside scenario for the dollar on cyclical forces is sort of like what you've negotiated and discussed in your recent flip side discussions with Ajay, Brad, the second round effects to growth, the overall big cyclical damage. Are we going to see delinquencies? Are we going to see layoffs, which will exaggerate the cycle beyond what we and the market or consensus kind of thinks? And equally, on the opposite side, if the job market data stays as resilient as it has been so far, we do have records and indicators of max bearish dollar sentiment, which could adjust for a stronger dollar in a way that quite surprises consensus here.
Thanks for the plug for the past flip side. I guess you want to be returning to this one. I appreciate it, Themos. But let's stick with, so if cyclical forces imply some modest downside risk for the dollar in your forecast, right? I'm the one who's a little bit more bearish here. So what would result into a larger dollar depreciation tail?
Yeah, two things. The first one could be a deeper, larger trade confrontation. I'm not sure we're going to see that. In some respects, it almost feels like we've seen some kind of peak tariff risk, for at least from a market perspective. What I worry more about is other items, including, for instance, the discussion on the replacement of the Fed chair. That could be quite scary in terms of the dollar.
Well, the president seems to have backed off the possibility of removing the Fed chair, even if he's not pleased with the job Chairman Powell is doing. The market volatility apparently has gotten in the way even before legal challenges maybe would have. So this one should be one of the easier debates to score, though, as we see how the dollar performs this year. I might actually be okay if you win this one so that my summer trip to Europe is a little bit less expensive.
Trust me, there's much more to see in Europe than how far your dollars would go.
Well, clearly I agree, because I let you convince me to have Greece as part of my summer holiday there. All right. Well, look, there's clearly a lot we've talked about on the dollar. We're going to see how that plays out throughout the course of this year. If I'm right, maybe you'll be back on here talking about alternatives to the dollar in the future. But thank you for joining us, Themos. Clients can read more on this topic in The End of the Dollar as We Know It. And for more on U.S. trade policy, check out Tariffs 2.0 Hub on Barclays Live.
That's all for now from this Barclays podcast. Thanks for listening, and we'll catch you next time on the flip side. For more insights on this topic, clients can log into Barclays Live or find out more at barclays.com/IB.